All right, welcome back to Talk Tickers. We're diving straight into Freddie Mac's first quarter 2025 earnings call today.
Yep, cutting through the usual jargon to get you the key info.
Exactly. So let's start with the big picture. How did they do overall?
Well, it was a pretty solid first quarter, actually. They reported net income of $2.8 billion.
Okay, $2.8 billion. And that did what for their net worth?
That pushed their net worth up to $62 billion now.
$62 billion. Wow. And it wasn't just financials, right? They were active in the housing market itself.
Oh, absolutely. They helped, 313,000 families either buy a home, find a rental, or refinance. So quite a bit of activity there.
313,000 families. That's significant. And I heard first-time home buyers were a big part of that.
Yeah, particularly on the single-family side. Over half of their new loan purchases went to first-time buyers.
Okay, good context. Now let's look under the hood a bit at the income statement. What were the main moving parts?
Right. So net interest income, basically their profit from lending.
Yeah.
That saw a decent year-over-year increase.
Okay, good news there.
But on the other hand, non-interest income, that saw a pretty substantial decline compared to last year.
Okay. So a bit of a mixed bag. What about expenses?
Non-interest expense actually went down a bit, which is good.
Right.
But they did increase their provision for credit losses.
Yep.
So setting aside more money for potential loan issues down the line.
Got it. So the headline $2.8 billion net income has some different stories underneath. Lending good, other income down, expenses mostly lower, but prepping for maybe more credit risk.
That's a good summary. Yeah.
All right, let's dig deeper then. That $2.8 billion net income, how did it compare exactly year over year?
It was actually up slightly, just about 1% or $28 million compared to Q1 2024.
Okay, so fairly stable. And you said the main driver was net interest income.
Exactly. That was up $343 million or 7% year over year.
And where did that growth come from?
It was really two things. One, their single-family mortgage portfolio grew. And two, in the multifamily business, they did more of those fully guaranteed securitizations.
Okay, explain those securitizations quickly.
Sure. Think of them as bundles of loans where the default risk is really low because of the guarantees. So it's a pretty stable income source for them.
Right, makes sense. So the core lending machine was humming along nicely.
Pretty much, yeah.
But then there was that drop in non-interest income. What was that about? $248 million down, you said?
Yeah, a 25% drop year over year. The main culprit was lower net investment gains, and that was specifically tied to their multifamily segment.
So investments linked to apartment buildings and rentals just didn't perform as well this quarter.
Compared to last year, no. That pulled the overall non-interest figure down quite a bit.
Got it. Okay. Now, on the flip side, non-interest expenses were down. How'd they manage that?
Those were down $34 million, or about 2%. And that was mostly because they spent less on credit enhancement expenses.
Credit enhancement? That's like reducing their risk on loans, maybe sharing it?
Exactly. They often do these things called credit risk transfer transactions, sharing risk with private investors. Lower expenses there probably means they did fewer of those deals this quarter.
Okay. And the last piece was that provision for credit losses, $280 million.
Yep, $280 million set aside this quarter. And the increase was mainly because they built up reserves in the single-family business.
For new loans specifically.
Right, for the new loans they acquired. It sort of suggests they might see slightly higher risk on these newer ones, even if the overall book looks okay for now.
Interesting. So even with a decent quarter, they're being a bit cautious on the new stuff. Okay, it definitely sounds like single family and multifamily had different experiences. Let's break down single family first.
Sure. Single family looks strong. Net income was $2.3 billion.
Wow, compared to last year.
Up 16%. Big jump.
Nice. And revenues?
Net revenues up 10%. And like you said, mostly driven by that 6% rise in net interest income from the portfolio growing.
And how big is that portfolio now?
It's huge. $3.1 trillion for single family. That's up 2% from last year.
But we just talked about the increased provision for credit losses in single family. How does that fit with the strong income?
Yeah, that's the nuance, right? They book a $228 million expense for potential credit losses there, up from $120 million last year.
And that's the reserve build for new loans.
Exactly. But interestingly, their outlook on house prices actually got better. They're now forecasting 4.2% growth over the next year.
Oh, up from what before?
Up from 2.7%.
Yeah.
So quite a bit more optimistic on house prices.
Which could eventually help offset potential losses, I suppose.
Potentially, yeah.
Yeah.
But for now, they're building those reserves for the newer loans acquired this quarter.
Makes sense. What about actual new business? Were people buying homes, refinancing?
Oh, yeah. New business activity hit $78 billion.
Which is up from?
up from $62 billion in Q1 last year. So a noticeable jump.
Both purchases and refis.
Both. Purchases were likely helped by, maybe those rising price expectations, maybe better market coverage, higher loan limits too, and refinance activity picked up.
Because rates dipped a bit.
Seems likely. Refis were 21% of new business, up from 15% last year. And yeah, the 30-year fixed rate did end the quarter a bit lower, around 6.65%.
And we already mentioned first-time homebuyers were a big chunk of that.
Yep, 52% of the new single-family business. That's about 81,000 households.
What did those new loans look like in terms of risk? Credit scores, LTVs?
They look pretty standard, pretty solid.
Mm-hmm.
The average guarantee fee on new loans was 54 basis points. The average original loan to value, or LTV, was 77%.
Okay.
And the average original credit score was 756. So fairly strong borrower profile on paper for the new folks.
That's reassuring. And the existing portfolio? Still looking okay.
Overall, yeah, the credit quality of the whole $3.1 trillion portfolio looks strong. The current LTV is down to 52%.
Meaning homeowners have built up quite a bit of equity on average.
Exactly. And the current average credit score is still high at 754. Plus, they have credit enhancement on 62% of that portfolio.
Okay, so lots of protection. But you mentioned delinquencies earlier. Did they tick up in single family?
The serious delinquency rate, so 90-plus days late or in foreclosure, was 59 basis points.
How does that compare?
It was flat compared to the last quarter, but up 7 basis points from a year ago.
Why the slight increase year over year?
They pointed to loans originated in 2022 and later, plus some lingering effects from past hurricanes. It's a small rise, but something to watch.
And they're doing workouts too.
Yeah, they helped about 25,000 families avoid foreclosure through loan workouts just this quarter.
Okay, good to know. Let's switch gears then to multifamily. You said that was a different story.
Yeah, quite different. Net income there was $533 million.
Which was down?
Down 35% year over year. Pretty significant drop.
And the main reason was that non-interest income we talked about.
Exactly. Non-interest income in multifamily fell by $427 million. It was a mix of things, results from buying and selling loans, securitization activities, interest rate hedging, and less favorable fair value changes on prepayments. Kind of a technical mix, but it all added up.
So more volatility in their kind of trading and investment side for multifamily.
Seems that way this quarter.
But the core lending, the net interest income, that was okay in multifamily too?
Actually, yeah, that part was strong. Net interest income was up 29% year over year in multifamily.
How?
Again, driven by doing more of those fully guaranteed securitizations. More volume there.
Okay. And their provision for losses in multifamily?
It was $52 million, actually slightly lower than the $61 million they set aside last year for multifamily.
Interesting. What about new multifamily business? Still active?
Yep, $10 billion in a new business volume, which was up $1 billion from last year.
And what kind of units are they financing?
They financed 89,000 rental units. And notably, about two-thirds of those, 66%, are classified as affordable for low-income families. So a big focus there.
That's a key part of their mission, right?
Absolutely. They also securitized more multifamily loans, $16 billion, up $5 billion from last year. And like we said, more of those are the fully guaranteed type, 56% now versus 36% a year ago.
And the fees they earn?
The average guarantee fee on the whole multifamily portfolio ticked up slightly by 5 basis points to 52 basis points.
How big is the multifamily portfolio overall?
Grew 5% over the year to $467 billion.
Okay. Now, what about delinquencies in multifamily? You flagged that earlier.
Right. The delinquency rate there hit 46 basis points.
Which is up?
Up 12 basis points from last year and up 6 basis points just from the prior quarter. So a noticeable increase.
And where is that concentrated?
Primarily in floating rate loans. That includes some of those smaller balance loans when they hit their floating rate period.
Is that a major concern given the increase?
Well, it's definitely something to monitor, but, and this is important, they said 98% of those delinquent loans have credit enhancement.
Ah, okay, so protection is in place.
Significant protection. And across the entire multifamily portfolio, the credit enhancement coverage is 93%. So while delinquencies are up, they seem pretty well insulated against major losses there.
Got it. So despite the uptick, strong buffers in place. Okay, let's zoom out again. Capital position looks strong, net worth up 24%, you said?
Yeah, net worth hit $62.4 billion, up 24% year over year. Very solid capital build.
And did management talk about strategy going forward? Any changes in direction?
Yeah, they definitely emphasized streamlining the business, boosting productivity. They talked about cutting non-essential activities, things that add cost without adding real value.
It makes sense.
They also mentioned supporting efforts to cut down on fraud and waste in the system.
What's the goal of all this streamlining?
Well, they expect it to lead to lower G&A expenses, administrative costs going forward. They also seem to be anticipating some regulatory changes that might help boost revenue and liquidity.
And what would they do with that extra efficiency or cash?
The idea is to reinvest in technology, keep building net worth, and ultimately help lower mortgage costs, contributing to that goal of a more affordable housing system in the U.S.
Okay, so efficiency internally plus maybe some regulatory help externally. Now let's put it all together for someone listening who might be an investor. What are the key takeaways?
Well, I think first that single-family strength is notable. The income growth there, driven by the portfolio and net interest income, signals, continued health in the core housing market, probably helped by rising prices.
Right.
Second, the multifamily picture is more mixed. The lower net income due to non-interest income issues and those rising delinquencies, particularly in floating rate loans, that warrants attention. Could be some sector-specific headwinds there, maybe.
Yeah, worth watching.
Third, that pickup in refi activity definitely shows how sensitive things are to even small moves in interest rates.
Good point.
Fourth, the focus on streamlining and potential regulatory shifts that could definitely impact future profits and how they compete. Investors will want to see if those savings and benefits actually materialize. And finally, you've got those two things we discussed. The more optimistic house price forecast from Freddie itself, and that slight uptick in delinquencies on newer single-family loans. Both are trends to keep an eye on.
Okay, clear takeaways. Now for the fun part, our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on this call. What do you have?
Okay, outrageous idea number one. Given all this talk about streamlining, efficiency, technology investment, and maybe regulatory tailwinds helping lower origination costs, you could speculatively consider a long position in a company that provides mortgage technology, like software or platforms that automate origination and servicing.
The picks and shovels play on efficiency.
Exactly. The idea is, if Freddie and others really push for tech-driven efficiency, these tech providers could see a boom in business. Highly speculative, hinges on a lot of ifs, but it connects to their stated strategy.
Interesting. Okay, got another one.
Idea number two, maybe playing the other side a bit. Based on those rising delinquencies in multifamily floating rate loans, especially the smaller balance ones.
Right, the ones you flagged.
You might, again, speculatively explore a short position in, say, a regional bank that has heavy exposure specifically to that type of commercial real estate loans, smaller balance, floating rate multifamily.
Betting that the stress Freddie is seeing might be more widespread in that niche.
Kind of. Betting that if delinquencies are rising there, maybe credit quality deteriorates more broadly in that specific segment, hitting lenders focused on it. Again, huge if, very targeted, definitely outrageous.
Outrageous but plausible, that's the name of the game here. Okay, let's hammer this home one more time. These are purely thought experiments, informational, for entertainment. Absolutely not financial advice. Do your own deep research.
Please do. Theoretically.
So that wraps up our look at Freddie Mac's Q1 2025 call. We've hit the key numbers, the trends, management's view. What stood out most to you? Let us know. Join the conversation.
Yeah, we'd love to hear your thoughts.
Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.